Guys, in this presentation, we are going to discuss about again the conceptual framework. At, and we discuss in this session about qualitative characteristics of general purpose financial reporting. So in the previous session, we talked about conceptual framework and introduction to the general purpose financial reporting. And now we are going to discuss about qualitative characteristics of general purpose financial reporting. Qualitative characteristics of useful financial information. So to consider a financial information as useful, so what are the characteristics should it consist? So that's what we are going to discuss. To consider and financial information as a useful, so what are the qualitative characteristics we need? Here, the qualitative characteristics of a useful financial information identify the type of information that are likely to be most useful. So all the informations are available around us are not useful information. All of them are not equally give us useful information. To consider an information as useful, it should satisfy some quality criteria requirements. So when we talk about the qualitative characteristics of useful financial information, it should have two characteristics. The first one is fundamental qualitative characteristics, and second one enhancing qualitative characteristic. So it's a fundamental. So if fundamental characteristics are not satisfied, then it cannot be considered as a financial information, useful financial information. Under the fundamental qualitative characteristics, most important one is relevant. The information should be relevant. That's called relevance. And the second one is faithful representation. When talk about enhancing qualitative characteristics, so this kind of qualitative characteristic will improve the quality characteristics of financial information. So mainly financial information, here they are referring to financial reports and its contents. Here, when we talk about enhancing qualitative characteristics, it's be comparability. It can be compared with similar organizations, similar entities, and it also compare with a previous year's financial information. Last year profit how much, this year profit how much. This is a previous year, and the same entity, the different time horizons, and company X how much performed, but the company X how much earned profit. A similar organization, company company Y, how they make profit. This is the inter-entity comparison. Common size, not common size, it's a inter-entity comparison. Verifiability means it should be verification. No, it should have evidences. Verifiability, information, verifiability, and timeliness. No, it should have it should provide up-to-date information, not out-of-date information, not expired information. It should give up-to-date information. Understandability, everybody able to, the reasonable knowledgeable people should have understand the things, informations disclosed in the financial statements. So these are the basic framework Now we are going to discuss this stuff one by one in detail. Right. Now we'll discuss about fundamental qualitative characteristics. Fundamental is a base. If financial information is to be useful, to consider a financial information is useful, it must be relevant. It must be relevant. Number two, faithfully represent what it purports to represent. Faithful, believeness, right? It can be believable. So, for example, relevant information. Right. If you want to assess, if you want to know about the profitability or gross sales revenue, if you want to assess the revenue of firm X, you have to take what information? You have to take information from where? We have to take information from financial statement of X company. If you take financial statement of Y company, then you interpret as revenue of X company. It is wrong because you take data, you extract data from company of Y's financial statement, but you want to take decision about company X. So this information is not relevant. Sometimes you want to know about company's financial performance, profitability, but you are taking information about its financial, its income, balance sheet. In the balance sheet, by looking at the balance sheet of an entity, you can't assess financial performance, but you can assess financial strength, financial position of the firm, but you can't assess financial performance. Even though you are taking the same entity's financial statement, you have to take most relevant information. If the information is not relevant, your information is not quality one. This information cannot be used. It cannot be used for taking decisions, any decisions. And faithfulness, faithful. Sometimes the information provider may not be a trustable one, may not be trustable one. Sometimes he may give us forged informations. Sometimes they may give make misleading. So it's what? Not faithful. We can't believe the information provided. So if you want to assess the revenue of a firm X, we have to take the annual report or financial statement or the income statement of company X. So in that time you ask the revenue of company X, that person instantly or suddenly says a certain amount, or he just instantly prepare some document and he shows, no, this is our financial statement. Can you believe? Is it trustable? No, it is not trustable. So to consider an information to be useful to take decisions, it should have it should meet two fundamental characteristics. That is relevant. That is relevant. The information should be relevant, and second one, faithful representation, a trust, faithful representation, what it purports to represent. So these are the fundamental qualitative characteristics of financial information. Now we look about relevance. Relevant financial information is capable of making differences in decision made by the users. You know, every users their decisions. They are taking a different type of decisions. So based on the purpose of the decision, based on the scope of the decisions, the informations will varies. The informations will varies. The relevant financial information is capable of making differences in difference in the decisions made by users. The financial information is capable of making a difference in the decision if it has predictive value. So it's predictable. It can be forecastable, predictable value, confirmatory value, and both. Predictive value, confirmatory value, and both. Predict mean we just forecast. Based on the past figures, we can guess, we can forecast, we can estimate the future. Very simple. We just looking at last 5 years data about the company's revenue, then we can easily forecast the next year profit. Conformity mean, we already predict based on the last 5 years sales data, revenue data, we estimate next year profit. This estimation can be confirmable based on the actual information. We have to wait for a period of time and we can confirm. Or what we can do, based on the previous information, we predict the present year's revenue. And also we have to take the actual figure of their revenue. Then we compare whether our prediction model is good or not good, poor. So this kind of things will be help us to decide the relevance of the information. Predictive value, predict, easily forecast. Financial information has predictive value if it can be used as an input to process employed by the users to predict the future outcomes. So if the past figures of sales helps to predict the present sales, then that information is relevant. It's predictable. If any information that is useful to predict the future estimate, future value, so in that case, that is relevant information. If it give us, if it helps to predict the figure, predict the future correctly, then the information is relevant information. Financial information need not be a prediction or forecast to have predictive value. Financial information, actually financial information are not predicted value. These are estimated value, actual figures. Financial information with predictive value is employed by users in making their own predictions. Users such as investors, they can predict their stock prices, share prices in the market based on their previous years performance. Based on their company's performance, they can predict their future value of their stock prices. If they're able to predict correctly, accurately, then we can conclude that the information is relevant. A confirmatory value, confirmation. Right? In the first stage, based on the data, past data, we can predict some value. Then we confirm that our prediction is correct or wrong. Assume that you flip a coin. Before flip a coin, you may ask whether it's head or tail. The person will say head or tail. Right? If the person says tail, then I flip the coin. If the outcome is tail, the prediction is correct. It's confirmed. This prediction is confirmed. So this is how confirmatory value. The financial information has confirmatory value if it provides a feedback about previous valuation. Now, when before I flip the coin, if that person X says it's tail, then outcome also tail. Then our prediction is verified, confirmed as correct predictions. But actual results, actual outcome is head, not tail. But prediction was tail, but actual value is head. Then the prediction is not correct. The prediction value and confirmatory values of finance information are interrelated. Information that has predictive value often also has confirmatory value. So predicted value will be confirmed in the later. For example, revenue information for the current year, which can be used as the basis for predicting revenue in the future year. Based on the current year sales, we can estimate the next year sales. Can also be compared with revenue prediction for the current year that were made in the past years. So then we also compare. So what is our predictive power, ability to predict? Whether predictions are closer to the actual values or not. If the predictive values are closer to the actual value, our prediction accuracy is high. The result of these comparisons can help a user to correct and improve the process that were used to make those previous predictions. Based on their prediction and the confirmation, they can assess the predictive power. If there is a more deviation between the predictive value and confirmatory value, so there is a problem in their information. So these instances, they can the entity can try to enhance their predictive power. We can depicts using this confirmatory value and predictive value in this picture. Here, from the past information, based on the past information, we can predict the future value. Yeah, based on the data 2015, 16, 17, 18, 19. Based on this 5 years data, we can predict year 2020. Yeah, 2020. So based on 15, 16, 17, 18, 19, this last 5 years data can be used to predict the value of 2020. So this is called what? Predictive value. So we have predicted value in 2020 and a actual value of 2020. Predicted sales in 2020, actual value in 2020. Now we compare. This process is called confirmatory value, confirm. Now we have actual value and we already have predicted value. Then we compare. So this process is called confirmatory value. Again, from this 2020 data, based on this 2020 data, we predict 2021. So this is called what? Predict. Then next year, end of year 2020, we will have actual value of year 2021. And we have predicted value of 2021. Then we compare. This is called confirmatory value. Materiality. Next part is materiality. Now we'll